In this video, we'll take a look at how to trade Forex CFDs. One of the biggest misnomers when it comes to Forex trading is the difference between spot Forex and CFD contracts. In the Forex world, this is essentially an interchangeable term from the retail standpoint, as the CFD contract, or the contract for difference market, is simply an agreement between two parties to exchange gains or losses based upon price movement of an underlying financial asset. In this example, I have the euro yen, and when you are trading a CFD, the underlying asset could be a currency pair like this. So what's the difference? Well, when it comes to trading the CFD market, this means that you are either trading against your own broker or a liquidity pool, an aggregate area where orders are mixed and matched between various brokers. It's essentially like its own kind of exchange, if you will. The owners of the liquidity pool just simply plug in orders to match each other. You know, if you're buying 50,000 units of this and somebody at another broker is just selling 50,000, you could connect in there and take the CFD contract on. When you look at the market, when you place a trade in the CFD market, you're simply agreeing to collect or pay out the difference. So if it's a $20 gain, you gain $20. If it's a $20 loss, they take $20 out of your account. You're not actually taking delivery of the currency like you might do in a physically settled futures contract, like orange juice or corn or something. When you're trading spot Forex, however, you are talking about trading the actual currency. It is a superficial difference for most traders, though, because quite frankly, at this point in time, CFD markets are much more common than actual spot Forex. Spot Forex does tend to be more expensive and a lot less efficient. All of this being said, you should keep in mind that the CFD broker does have the ability to charge whatever price they want, at least in theory, although you will find all of them within about a tick or two of each other. The days of brokers widening out their spreads ridiculously and things like that, they're long gone. And it's become a very competitive marketplace, so they have to serve the customers a little better. How to get started? Well, the simple answer is to open up a brokerage account. Make sure that you open up an account with a company that is regulated in a major marketplace such as the European Union, the US, the UK, Japan, places like that that are highly sophisticated from a financial standpoint. Long gone are the days of brokers that do unscrupulous things, as the regulations that overhang their actions are so stringent, especially in those economies that I mentioned. As long as you stick with the major economies, you should have no real problems. They give you a way to address issues through regulatory bodies. By opening up the account, you have the ability to bet on the movement of a currency in Forex markets without actually having to exchange that currency itself. This is as simple as buying or selling, like we would do here on this chart, or a pair like the euro dollar or whatever, and collecting or taking the debit depending on if the trade works out for or against you. Obviously, there's a whole litany of strategies that you can employ and fundamental analysis that, of course, you can start to take up, which does go far beyond the scope of this video. But you can see, this gives me the ability. This is the euro yen. I could buy or sell various amounts and set where I stop loss or take profit. Pretty straightforward. Don't have to take delivery, don't have to do the conversion or anything else. It just gives me the difference or takes it out of my account.